In this section, we're going to be talking about how to read a bond prospectus. This is obviously a very important key document for any bond investor. I mean, Jeremy, if I could start with you, what are the key areas which investors need to be looking out for when they're looking at these prospectuses?
I think from a retail perspective, I mean, the little booklets that the lead managers produce for the retail bonds have been very, very handy indeed, very useful for the investor to get an idea, a snapshot. I mean, we obviously, unfortunately, I think the only other real answer is to say people have to read the prospectus to the full, but I think with the booklets provide an insight which will guide you in the reasons of the prospectus you should be looking at. And I think for people, just the coupon is always the thing that will attract people's interest in the first place. And then secondly, I think you've got to look at the maturity, etc. Now, the thing we would break down after that is I suppose you go straight to covenants and how the bond is structured, where it ranks within the company's structure as far as debt's concerned. Most are senior unsecured, which is basically the rank that most corporate clients or corporate issuers, when they actually issue a bond, will put it into that sort of area. They then have to make sure that it ranks pari passu, which ranks equally with the existing senior creditors. And it also has, I mean, unusually, some of the bonds are secured, some aren't. Property tends to be secured because they don't have a rating per se. And which means that you have to then make sure that the security that they've given also ranks pari passu with the existing creditors. So you've looked at, so basically once you've got round the maturity to make sure that you understand the maturity, you understand the coupon and the way it's paid, maybe annual, semi-annual, and you're happy with the fact that that fits your criteria, then look at the covenants. And then, of course, the other thing to worry about is liquidity, and are there more than one person making a market? And it's especially useful for the retail bond market is it listed on ORB, and will it be regularly traded with it? Are there more than one company willing to make a price in that bond?
Absolutely. You mentioned a couple of things there: maturity, this idea of pari passu within the bond structure, and also the secured and unsecured. I just wonder if we could go through each one of those things in turn, really. Darren, starting with you on maturity. What are the key considerations here, the different types of bond maturity and the qualities and drawbacks that they have?
Sure. So if we go back to before the financial crisis, many companies, not just in the UK, but globally, used banks for their financing. And that was fine because banks provided plenty of financing. It was relatively cheap. And they had no problem in going to the bank and raising new finance or maybe looking for the best interest rate. Financial crisis came along. Banks had less ability to lend to companies. And so companies found all of a sudden the benefit of being able to term out your debt was a good thing. And to term out your debt, that essentially means that instead of maybe having a bank facility which might last for 1 year, 2 years, 3 years, a company could issue debt for 5 years, for 10 years. In some cases, you can issue debt for 100 years now. Certainly some global companies have done that. The sorts of companies you'll see on ORB in general will have maturities ranging, say, between 5 years and 10 years. That's seen as an appropriate compromise of time from when the issuer would like to issue for as long as possible, probably. And we as investors don't want to take too much interest rate risk. This risk we talked about before, that the further out the debt maturity, the more uncertainty you have about future interest rates. And typically when the interest rates go up, bond prices go down, although it's far more technical than that. So when maturity in general, what we have seen is maturities have been between 5 to 10 years.
This term pari passu, which investors will often see in bond prospectuses, what does that mean, and what does it tell you about the bond that you're investing in?
Very simply, I'm just trying to keep it this way, is that if a company issues new debt as an investor, you'd like it to be equivalent in the capital structure to current debt that's already issued, or even higher, as the case may be. What you don't want to do, and this is where the point about the booklets and reading your prospectus properly, or giving it to a lawyer or wealth manager, is buy something that you believe is on the current terms of debt that's already in existence, and actually it's subordinate to that, meaning it's lower down in the debt structure. So if the company has difficulty, you could find yourself in a situation whereby you're not getting your capital back, or you're getting less coupon. So another key point on reading issues on the prospectus is that Jeremy raised was, well, what are the covenants? So what happens if it goes wrong is something really to look at. Remember, it's just a loan, it's an investment, and that's something you should consider.
And I suppose that also feeds into the secured and unsecured debate, which you'll also find in the prospectus.
I mean, let's face it, when you buy a bond, the underlying transaction is you're lending this organisation some money. So whether you're lending an organisation some money or one of your friends in the pub, you want to have an understanding of what's my interest rate on this, when will I get my money back, what security do I have, and what guarantees can you give me that you're not going to borrow money from other people or other organisations, which puts my original loan at risk. So when we look at securitisation, one of the nice things to have, if you're able to find it within the prospectus, one of the nice things to have is, in the event that the organisation is unable to repay its loan due to cash flow issues, that you're able to seize some assets. You've got security on some assets that you can then sell and then recover your original loan proceeds.
And I suppose that gives you the security that those underlying assets are going to be worth some proportion of the loan that has been made.
Absolutely. When you buy a bond, the two risks that you need to assess when you're understanding credit risk is, what's the probability that these people can or cannot repay me? And in the event that they can't repay me, how much money can I get my hands back on? And it's actually the second one which is much more important when it comes to pricing bonds. The probability of default is what you'll see in a credit rating, but the thing that really matters is, what's my recovery in the event of default? And if you've got security on high quality assets, and where the value of those assets exceeds the value of your loan, the probability of default isn't really a key consideration, because you can get your hands back on that money quite readily by realising those assets.
I mean, if I can add to that, we do get terms within the bond market. For example, we have this phrase, senior unsecured. You're a senior creditor of the company, but you have no security. Another phrase might be senior secured. So you are a senior creditor and you have security, which in the case of a property company might be a bunch of property assets that the company can sell, and you will receive the proceeds of that. But this thing about understanding the capital structure of a company is quite important. Traditionally, banks are at the top of the capital structure, so if something goes wrong, a bank will get their money back first, and even though you're a senior unsecured creditor of the company, you will get your money back after the banks. But there are some bonds that are issued where you rank pari passu, so at the same level as banks. So understanding those risks and knowing where you stand within the capital structure is an important thing to work out.
Picture it like this: you're in a queue. So imagine the queue outside the nightclub. What you're doing when you're going through the covenants is you're understanding where you sit in that queue. Now, if you're a bank, if you're a senior secure creditor, you're like a VIP entrance. You're at the front of the queue. But of course, if you're a unsecured creditor and a subordinated creditor, that means that you're at the back of the queue. So when they're handing out the goodies at the end, where you are in the queue really determines what your recovery rate will be.
It's a very good point. I mean, to pull in all the points we just made and the panel has just made on this, you have to look at debt sustainability, but invariably the banks will be ahead of you in the queue just after the tax department. So you know that, well, the Inland Revenue, I should say, but you know that you have to look at the debt status of the company, but then you do have the added comfort if you are senior secured, but you do have to make sure, which is why the prospectus is important, because it will give you the latest breakdown of the company's liabilities and their borrowings, and to what percent is secured and which percentage is unsecured, which is important if you're senior unsecured.
Rather an obvious point is as well, the higher up the capital structure, or the closer to the front of the nightclub you are, the less as an investor you're going to receive for that, which is rather obvious. And if you're at the back and you're willing to take a little extra risk for going subordinated or unsecured, then you will pick up a little bit more. But obviously that works out in a nice diversified portfolio.
But generally on the prospectus, I sometimes can seem like quite a weighty tome. There's a large book, it has lots of details in it, but it will have things like details about the company. If you want to read about the company, it will have its financial accounts. The company will tell you the things that the company's worried about, so the risk factors of the bond, the covenants that we talked about, those guarantees that might protect you. There's lots of interesting information there that's really helpful to all investors, including ourselves as professional investors, but also for retail investors.
I suppose within these prospectuses there is a lot of detail. Do you ever unearth any red flags where you find something which makes you think actually there's a lot of risk within this investment?
It's a difficult one because I think first thing is I think most people will look at it from, they look at it if the company's rated. Now, I think if you look at it this way, if a company has a rating from one of the recognised rating agencies, it does make things a little bit easier because you will have their latest report normally provided by the lead manager and mentioned in the prospectus to some extent. I suppose it's not particularly a red flag, but I think if a company is unrated, it means that you have to do a more comprehensive due diligence and to make sure that you have to look. The company might be sound, solid. That's not necessarily the case that it hasn't got a rating, but it does mean that by not rated, it probably means you need to do your own due diligence, and it also means that not by definition, but it's going to be a higher risk to you for one reason or other why the company hasn't attained a rating. It might not be, as I say, anything suspicious, but it might be the fact pure cost of the rating is too much for that company to incur, or it might be the fact that that there's no need for them because you're secured on a portfolio of assets in some way. But yeah, it's not red flags. It's difficult to isolate because each company is esoteric. They have their own sectors that they operate in, and each sector is different. We could talk about debt to equity ratios, but obviously a financial company's debt to equity ratio is going to be a lot higher than an ordinary company which probably has a low gearing ratio. So it's difficult to give a list of red flags, but I suppose to make things easier, look at a rating which would basically make your job in analysing a company easier rather than looking for red flags.
Absolutely. Okay, I think that's everything an investor could want to know about bond prospectuses. So thank you very much for that.